we've got a case study. This is loosely based off of some entrepreneurs we've got who have set up very similar structures here. But let's assume that we got an entrepreneur that's making $20 million a year in annual taxable income, so not revenue, but take home, operating real estate businesses. They got GP stakes, just a lot of different things going on within the real estate sphere. 9-figure balance sheet already. They're managing 4 to 6 active development projects, tracking 30 plus passive K1s and passive deals. And then on top of that, they're also paying $400,000 per year in non-deductible expenses, right? Attorneys, advisors, right? All these different professionals just to help kind of manage and keep all of this stuff clean. So that's the setup here. And so the idea is, hey, okay, should this entrepreneur create their own family office LLC, whereby this family office LLC would be able to provide services in terms of delivering services to operating the real estate companies, passive investment, holding entities, individual development, project LLCs, personal accounts, right? The family office LLC could provide services to all of those different things that are going on in this entrepreneur's life. And then the revenue model, which again is important to make this.
And what do you mean by personal accounts? Can you elaborate on that a little?
Yeah. So within the family office LLC, this would be, for example, if you have stock account, bond account, crypto account, right? Anything to that effect, the family office LLC would be able to manage those investments.
Portfolio management, traditional investments,
exactly.
Stuff like that.
Performance reporting, cash flow reporting. There's going to also be asset protection, insurance, all of that kind of stuff that would be baked into this.
Got it.
So you got to put together a legitimate revenue model. So here, hypothetically, let's assume we've got an $80 million passive portfolio. They charge 25 basis points on that. So 0.25% times 80 million, that's $200,000 a year of revenue. They could also charge an operating business retainer model of maybe $150,000 a year for financial oversight and financial planning. And then maybe there's consulting fees for each active development. So there's clear line of sight here to $450,000, $500,000 a year of, again, arm's length revenue that the family office LLC would charge to these different entities and to these different projects that the entrepreneur is setting up.
Got it. Yeah.
You with me so far?
Yeah, makes sense.
Okay, so what are the services provided? So let's say we get some consolidated reporting. That'd be one big thing. LPGP tracking for all of these different K1s and the passive deals, capital calls, distributions, performance reporting, cash flow forecasting, liquidity management, due diligence. That's very important. Deep diving and also on-site, off-site due diligence.
And by the way, if you're listening, these are all areas that you should be thinking about tightening up and having under control, whether you're doing a family office LLC or not. Things like when you said consolidating reporting across 35 plus entities. Well, a lot of entrepreneurs have 5 entities or 10 entities, and they have no idea about the compliance with them, the operating agreements, how the money flows between them, how it flows into the tax returns, let alone things like cash flow forecasting and liquidity management. So everything that Bryce, you're talking about, our listeners should also be paying attention to within their business.
Yeah. I mean, and these are things that they should be doing right now. The difference is they're not able to potentially deduct these expenses, whereas by tucking them in underneath this family office LLC, using that lender management tax court case as a guide, they now become deductible.
Yeah. And what's interesting is usually these entrepreneurs had a business and a big business exit. And if that's the case, they're used to writing everything off through their business. Now their business is gone.
Yep.
And they're saying, well, I have no write-offs.
Right.
And this is a great way to get legitimate write-offs through actually doing something that's going to help them manage their wealth in a much better way.
Yep, exactly. So here, deductible expenses, right? Let's assume that you're going to pay a fractional family office or bookkeeper, or you have a full-time employee. You got different professional services, tax prep, legal, compliance. You got tech. You got travel. Now, we're going to talk about that. Aircraft, as part of that, we're going to jump into this. In this case study, the entrepreneur also owns a private plane, and we're going to talk through how you can actually legitimize the deductions on some of that. Vehicles, other. So here we totaled up maybe about $490,000 of expenditures. So if the revenue here was, $450,000, we now have $490,000 of expenditures. That would show up as a $40,000 loss, right? And we could actually take that loss. And remember, even in that revenue, we're pulling it out of affiliated entities, again, at arm's length. So we're effectively reducing the taxable income in these other entities by pulling money out and starting a new P&L in the family office LLC. But again, as you can see with this case study, with this example, everything legitimate, documented, agreements put in place.
The key is wealth building. And so especially entrepreneurs, because usually entrepreneurs who have a 9-figure balance sheet are maybe a little bit better at wealth building. They've made it there. But just keeping in mind that whenever you're doing anything to save taxes, for example, there should be a component that's building wealth, not just buying cool stuff or buying stuff for my wrist, but just but actually wealth building for the future of you and your family.
Yeah, I 100% agree. That's the why. So to wrap this up, there are reasons beyond just the legitimatizing of the expenses to write it off for tax purposes that you would want to consider this family office LLC. And two big ones. One is going to be governance. And so in these LLCs, when we set these up, we generally, within the operating agreement, want to incorporate succession planning into the governance. And so we can structure different, really what we want to do is structure different investment committees. We want to maybe even do distribution committees of like, hey, what do distributions look like from these LLCs? How does this feed into generally dynastic trusts setup? This is usually all intertwined. And so it allows kids to become, or heirs, become more involved. And then also there's generally a charitable or philanthropic overlay. And so maybe it's not directly through this entity, but the family office will generally then be able to provide some sort of management or other services, perhaps to dynastic trusts that may own a lot of the actual assets that the entrepreneur has, created over time or built up over time. So yes, there's a tax angle, but there's also this can be a dual sword here, and also used for governance and succession planning.
Yeah, and I love the thought about multi-generational education and accountability and apprenticeships where young people can learn. I know just recently the rumor is that Warren Buffett changed his estate plan, and he was originally going to give a very small amount to each of his kids, and he decided he's now going to pass 99.5% onto a foundation that the kids are his 3 adult children are going to manage, and they're going to share 0.5%. So what that means is $250 million per kid is 0.5%, because he feels like they're now mature enough to handle $250 million, but that's 0.5% of his estate, and then they're going to work together to manage $150 billion for charity and for philanthropy. So he's doing that within his plan, just at a larger level than most anybody in the world.